What's the best S&P 500 ETF? The answer will be different depending on your goals. We're going to walk through core criteria for analyzing the top S&P 500 ETFs. These criteria could be used to help you analyze any ETF. It's good knowledge regardless. If you're new to my channel, this is what it's about. My name is Nick, and my goal is to teach you about investing and help you become financially independent. I've created numerous videos to help you learn critical investing topics like asset allocation, international diversification, tax efficiency, ETFs versus mutual funds, and dissecting funds like we will do today. I pack a lot of value into my videos for free. All I ask is that you smash the like button and subscribe to support free financial education. The top ETFs we will compare in this video are SPY, IVV, and VOO. All three of these are S&P 500 index funds. These are offered by three of the largest asset managers. SPY from State Street Global Advisors, IVV is an iShares ETF from BlackRock, and VOO is from Vanguard. My shirt may give away my preference, but let's walk through how to compare these ETFs. The most significant factor in this decision is going to be your investment goals. Are you a buy and hold investor, or do you want to speculate with options and trade more frequently? If you're a buy and hold investor, IVV or VOO are best in my opinion and are nearly equivalent. If you want to speculate, SPY is generally better. Let's briefly compare the performance of these three ETFs with Portfolio Visualizer. If we had invested $10,000 in these ETFs in January 2011, the performance through October 2021 is nearly identical across the board. Compared to SPY, IVV would have put an extra $215 in your pocket, of VOO an extra $247. There are a couple reasons for this difference in performance. Let's walk through them. We'll use ETF.com to compare these funds. The first difference in performance is due to the fees, or the annual expense ratio. SPY has an expense ratio of 0.09%. On the $10,000 investment, this would be $9 per year. You don't pay these directly, they are paid for from the fund's returns. IVV and VOO have an expense ratio of 0.03%, or $3 per year on the $10,000. This is 1/3 of the fee of SPY. Why pay 3 times the fee for SPY if you don't have to? We'll get to why speculators might want to do that. However, this probably doesn't explain the entire difference in performance. The next factor is the legal structure. ETFs can actually operate under different legal structures. We can see SPY is a unit investment trust, while IVV and VOO are open-ended funds. This means they are regulated by slightly different legal codes. The main difference as it relates to performance is that a unit investment trust is not allowed to reinvest dividends in the same way open-ended funds are. In fact, SPY holds dividends received in cash until they pay them out to investors quarterly. This is called a dividend drag. If the market is going up, that cash is missing out on potential returns. IVV and VOO can reinvest dividends immediately until they pay them out quarterly. As a buy and hold investor, you would rather have your dividend reinvested immediately. The expense ratio and the legal structure probably explain most of the performance difference of these ETFs. Whenever you evaluate an ETF, you should consider some additional factors. First is the net asset value, or NAV, the NAV. This is how much investments in the fund are currently worth. SPY has about $445 billion. IVV has about $447 billion, and VOO has $417 billion. They're all comparable and have a lot of money invested in them. Next is the average daily volume. This is the value of shares traded each day. SPY has $30 billion traded per day. IVV and VOO have $1.8 billion per day. SPY is off the charts here, almost 15 times the daily volume of IVV and VOO. $30 billion per day of the $445 billion NAV is about 6.7% of the SPY shares that are traded each day. This is why this fund is better for speculators. There are far more derivatives available for SPY, and it trades with a lower bid-ask. The bid-ask is just a spread between what someone will sell a share for and what someone will buy it for. The difference is collected by the market maker. It basically functions as a commission for organizing the trade and connecting the buyer to the seller. For SPY, we can see the spread is very low, with an average of around 1 cent per share, the current share price of $456. For IVV and VOO, the spread averages about 2 cents per share, where IVV has a current share price of $458 and VOO at about $421. The tighter bid-ask spread is another reason why SPY is probably better for speculators. The next factor to consider is the premium. Throughout the day, the value of the fund's shares will fluctuate from the fund's net asset value, or NAV. For very liquid funds, the premium is usually very low. If the premium gets too large, market participants are incentivized to arbitrage the difference. All of these funds have a somewhat comparable premium to discount. Next is the tracking error. If you're buying this ETF because you want to get the performance of the S&P 500 index, you care about how well the fund does at matching the index's performance. We can see that in the past 12 months, SPY had a median tracking error of negative 0.14%, while IVV had a median tracking error of negative 0.04%, and VOO negative 0.03%. The tracking error is roughly matching the expense ratio for IVV and VOO. There's a little extra for SPY. Nobody knows which will be the best at tracking the index in the future, but I would expect VOO and IVV to track better than SPY due to the better fees and fund structure. Next is the securities lending, which is if the fund lends out securities it holds to generate a little extra return. SPY does not lend securities. IVV and VOO do lend securities. I personally don't think this matters and like that it keeps my expenses lower, but some people care and don't like their securities being lent. The final factor we'll look at are options. If you want to speculate on options, SPY is your best bet, pun intended. Some people believe they can boost their returns by selling covered call options or employing other strategies. Maybe it works for them, but I believe most people will not earn an extra return from doing this, especially not one that's worth their time. There are actually ETFs that buy SPY and sell covered calls for you. I made a video about some of the most popular covered call ETFs, which have all underperformed simply buying and holding the underlying ETF. I detailed why I believe selling covered calls is a bad strategy in that video. I'll link it up here and below. SPY, IVV, and VOO are all excellent options. We're really splitting hairs when we're analyzing the difference in these funds. In my opinion, most people will be best off with a simple buy and hold strategy in IVV or VOO. Vanguard's tracking error has been better recently, and I like that Vanguard is owned by investors in its funds. It's not a for-profit company like BlackRock. You can buy most of these ETFs from any brokerage, so access is pretty universal. One last point I want to make is that I prefer other ETFs to the S&P 500 ETF. There are two reasons. First, the S&P 500 only tracks 500 of the largest US companies. A total stock market ETF, like VTI from Vanguard, invests in nearly 4,000 companies, or nearly every publicly traded company in the US market. The second reason is I prefer international diversification. An ETF like VT from Vanguard invests in roughly 9,000 companies around the world in over 40 countries. This single ETF can get you global exposure to nearly every publicly traded company in the world. It is extremely simple. I made other videos on VT, the Vanguard Total World Index, and on the S&P 500 versus the Vanguard Total US Index, and on international investing and different international fund options in general. If you want to learn more about any of these topics or asset allocation, make sure to check out my other videos. If you got value, make sure to smash the like button and subscribe. Thanks for watching, everyone. Later.